In today's financial reality, millions of people struggle with the weight of credit card debt, and with rising interest rates in 2025, the challenge has only gotten harder, which is why more and more people are asking the same burning question: should you use personal loans to pay off credit card debt? On the surface, the idea sounds simple. You take out a personal loan at a lower interest rate and use that money to wipe out your expensive credit card balances. But before you make that move, it's crucial to understand the pros, the cons, the hidden traps, and how it fits into your overall debt payoff strategy. This video is your brutally honest guide to pay off debt in as little as 6 months if you're disciplined, motivated, and ready to make some lifestyle changes. So let's break this down step by step. First, let's talk about why credit card debt is so dangerous in the first place. Credit cards are designed to be convenient, but they are also designed to keep you in debt because the average credit card interest rate in 2025 is hovering around 22% to 28%, which means if you carry a $10,000 balance, you could be paying thousands of dollars in interest every year, and minimum payments barely scratch the surface of what you owe. This creates a cycle where you feel like you're paying but your balance never really moves. That's where personal loans come in. Unlike credit cards, personal loans typically have fixed interest rates and fixed repayment terms, usually between 2 to 7 years. If you qualify for a personal loan at, say, 8% to 12% interest, you could potentially cut your interest rate in half, save money, and have a clear timeline for when your debt will be gone. But here's the catch: personal loans aren't free money, and they come with risks you need to think about. For example, if your credit score isn't strong, you might not qualify for a low-interest loan, and you could end up with a rate that's just as high as your credit cards, which defeats the purpose. Also, personal loans may come with origination fees, prepayment penalties, or other hidden costs that eat into your savings. Another big risk is behavioral. If you use a personal loan to pay off your credit cards but then turn around and start swiping those cards again, you'll end up with double the debt, and that's a financial disaster. This is why using a personal loan must be part of a bigger strategy and not just a quick fix. Now, let's pivot to the brutally honest guide to pay off debt in 6 months. The truth is, most people don't pay off debt quickly, not because it's impossible but because they don't have a plan, they don't track their spending, and they underestimate how much they can really cut back. If you want to be debt-free in half a year, you need a combination of mindset, math, and method. The mindset is simple. You must decide that debt is no longer an option, you must commit to stopping the use of credit cards completely, and you must be willing to make sacrifices that most people aren't willing to make. The math is about understanding how much you owe, what your interest rates are, and what your income looks like. If you owe $12,000 on credit cards and you want to pay it off in 6 months, that means you need to pay $2,000 a month, which sounds impossible for many, but if you break it down, cutting unnecessary expenses, selling unused items, picking up a side hustle, or even using a personal loan strategically, it becomes more realistic. The method is about execution. There are several proven strategies to tackle debt: the debt snowball, where you pay off your smallest balance first to build momentum, or the debt avalanche, where you focus on the highest interest rate first to save the most money. Both methods work, but the avalanche method is especially powerful when paired with a personal loan because it can instantly reduce your interest burden and allow more of your payment to go toward principal. Let's look at an example. Suppose you have 3 credit cards: Card A with $5,000 at 25% interest, Card B with $3,000 at 22%, and Card C with $4,000 at 27%. Your total debt is $12,000. If you stick to minimum payments, it might take you over a decade to pay it off and you'll spend tens of thousands in interest. But if you get approved for a $12,000 personal loan at 10% interest over 3 years, your monthly payment might be around $387, and you'll know exactly when the debt will be gone. If you push harder, double up on payments, and pay $800 to $1,000 a month, you could clear the entire balance in about a year or less. Combine that with aggressive budgeting and extra income, and 6 months becomes possible. But here's the brutally honest part: it's not easy, and most people won't do it. It requires canceling Netflix, skipping vacations, cooking at home, and maybe even moving to a cheaper place or selling your car. It requires saying no to friends when they want to go out and saying yes to working overtime or starting a weekend side hustle. That's why so few people actually become debt-free quickly, because they aren't willing to go through short-term discomfort for long-term freedom. But if you are, the rewards are life-changing. Imagine the relief of no longer sending hundreds of dollars every month to banks in interest payments. Imagine the freedom of using your income to build wealth instead of servicing debt, and imagine the peace of mind that comes from being in control of your money. That's the payoff, and that's why this guide matters. So, should you use personal loans to pay off credit card debt in 2025? The answer is, it depends. If you have good credit, can qualify for a loan at a significantly lower interest rate, and are committed to not racking up new debt, then yes, a personal loan can be a powerful tool. But if your credit is poor, the rates aren't much better, or you haven't addressed the habits that got you into debt, then a personal loan might just make things worse. Instead, you may want to consider alternatives like balance transfer credit cards, debt management programs, or even negotiating directly with your creditors. At the end of the day, the tool you choose matters less than the commitment you make. A personal loan, a snowball plan, or even a DIY budget can all work if you actually stick to them. The real battle isn't against your debt, it's against your spending habits, your mindset, and your discipline. And here's the ultimate secret: paying off debt fast isn't about perfection, it's about consistency. You don't need to do everything right, you just need to keep making progress every single month. If you fall off track, get back on. If you slip and use your card, stop and refocus. The key is not giving up. So if you're serious about becoming debt-free in 2025, start today, calculate your debt, explore personal loan options, cut your expenses ruthlessly, increase your income aggressively, and attack your debt with everything you've got. 6 months from now, your financial life could look completely different, but only if you take action today. Remember, debt doesn't have to define your life. It's just a chapter, and you have the power to write the ending. So take this brutally honest guide, decide your strategy, and make 2025 the year you finally break free from credit card debt for good.